Hello, David Moore with Equity Advantage and IRA Advantage, IRAadvantage.com. And I just want to hit something real quick. With the market being the way it is, the pressure on it, the lack of inventory, the urgency of acquisition, maybe the additional down payment that's required to get a deal done. We're having more and more of our clients are wanting to combine IRA funds along with personal funds to make an acquisition happen. And I just want to put out there, when I look at any exchange, if you've watched my videos, you've heard me say it before, I'm going to break it in 4 basic components. It's got to be an exchange. What's getting received have to be of like kind. We need to, for total deferral, go across or up in value and equity. I want to stress it's 1031's not all or nothing though. So don't worry about spending every dollar you have to. If the perfect property is less than what is needed for total deferral, that's okay. You're just going to pay tax on the difference. So I say every dollar you spend more than you want costs you $1. If you don't spend it, maybe it's 30 or 40 cents. So 1, it's got to be an exchange. 2, what's going to receive for like kind. 3, we satisfy what we call the napkin test, which says across or up in value and equity. And finally, we have to have continuity vesting. The person or entity that gives us something has to be given something back. If I look at retirement accounts, I'm looking at 2 primary issues. What does the person want to buy, and who are they transacting between or for the benefit of? So when I talk about what's able to be purchased with a retirement account, you can buy with an IRA literally anything other than collectibles, life insurance contracts, or stock in a sub-S corporation. If we're looking at a 401k plan, the only thing you can't buy is collectibles, period, one thing. So rarely is the investment a problem. What triggers problems for people with retirement accounts is that second factor, transactions between or for the benefit of a disqualified party. So 1, who's a disqualified party? Well, your lineal ascendants, descendants, their spouses, or any legal entity owned in a controlling interest by one of those. I didn't mention siblings. Siblings are not disqualified parties, nor are aunts, uncles, cousins. Okay, you can't transact between or for the benefit of a disqualified party, but this is very, very important. You can transact along with a disqualified party. So if you've watched our videos on the Equity Advantage channel, 1031exchange.com, you've probably heard me say that the combination of qualified money, IRA 401k funds, and 1031 funds is going to require tenancy and common ownership structure, which is true. So if we're putting a 1031 together and you want to add funds via your retirement account, that retirement account is going to be an additional purchaser of the property. It's not you, it's not your money, so it's going to be a tenancy and common ownership because 1031 specifically prohibits the exchange of partnership interests, which a membership interest in an LLC would be. So we need to use a tenancy and common structure not because it's an IRA, but because we're using 1031 money to get into it. So we need to make sure we're taking care of that. But when we're combining those funds, I want to stress once again, it's not a prohibited transaction to transact in combined personal money and plan money into a common investment. But if we're using 1031, it's going to require tenancy and common structure. If we're not using 1031 money, we can use either tenancy and common, or we can use a new limited liability company that would have both your retirement account, or technically speaking, the trust company for benefit of your IRA, along with you as members of that thing. Now, if we fund a MultiMember LLC with 2 disqualified members, we can fund it, the initial funding's fine, but we cannot have additional money coming in from any disqualified source in the future. So we need to overfund that funding of the LLC, and that's one of the reasons I like the tenancy and common structure. If you're using a TIC, you need to have an IRA-specific tenancy and common agreement, though. You can't just, number 1, have a TIC agreement, but number 2, the provisions in that agreement need to be specifically spelled out to be in compliance with IRAs, okay, or 401k plans. But I just wanted to bring that up because it's coming up more and more and more. The other reason, another item you need to think of when you're looking at financing, if you've got financing involved with that acquisition, 2 things you have to be aware of. 1, with an IRA, even with a Roth IRA, if there's income or gain attributable to other people's money, which a loan is other people's money. If you buy a property 50% loan to value using an IRA, you're going to have tax exposure on half the income and half the gain on disposition. If it's debt-free, then you're not going to have that. And I want to stress, even with a Roth IRA, you're going to have tax exposure. If you have a leveraged investment, if you've got a loan on it, you're making money off other people's money, you will have tax exposure on the income or gain attributable to other people's money. Not a problem, just factor that into your return on investment, but it's going to be there. But the reason I bring up lending or loans in this video is that if we're going to combine personal money and plan money into a common investment, it has to be non-recourse debt. Okay, what that means is it's got to be an IRA 401k compliant loan. And ultimately, that means that you, if you're the IRA owner, you cannot, that loan's not going to be subject to you, your credit, your income. You are not on the hook for that loan. If you're on the hook for it, it's recourse to you, therefore it's a prohibited transaction to get it done. So any loan that's specifically for an IRA 401k, the only recourse the bank has in a default is to take that asset, period. Now you say, well, gee, it's non-recourse to my IRA. I'm just going to have it recourse to me on my piece of this asset. Doesn't matter. The loan was made because you're in there. So it doesn't matter if it's non-recourse on the IRA piece and recourse to you on your personal piece. That doesn't work. It's got to be totally non-recourse, and you're going to have to deal with a bank, a lender that's going to work with that. Typically, if you work with a credit union, their first comment might be, oh yeah, we can take care of that. They're not going to be able to take care of it. At least I've never met one that we got a deal done with, and it's for a variety of reasons. But number two, you're going to have to work with either a regional bank that understands this stuff or a bank that's set up specifically to make that type of loan. If you've got questions or concerns on that, get a hold of us. But I just, the main point of this video is I want you to understand you can go out and buy a property using personal money and plan money in a common investment. It's got to be structured. It's got to be done right. Don't come to us at the 11th hour when you're closing tomorrow trying to get it done. We need to take the time to plan it out correctly to make sure we're getting where you want to go. And if there's anything I've learned over the dozen years we've been handling retirement account transactions is that people are conservative with their retirement accounts, and rightfully so. And we need to make sure that we're doing things correctly from the onset of the deal. Don't try to throw it together. It's not worth it. The cost of a prohibited transaction with an IRA is full distribution of all funds in the account as of the first day in the year in which the indiscretion occurred. So you don't want to screw up. 401k plans, much better situation in a prohibited transaction, only money involved with indiscretion. But these are all reasons you want to have a great team of people. You've heard me say it before. I'm going to say tax people are critical. They're the ones that are going to be sitting there with you day in, day out, and don't use them come April 15th. Talk to them before year's end. Look at what's going on. If you sold a property, want to pay the tax, you got other things out there. If you've got a transaction that's triggering some tax exposure, look at what else you've got in your life that can offset the gains with losses or so on and so forth. But give your tax people some time to deal with what's coming up. So I hope you found this helpful today. Hope the season finds you healthy and happy. Wish you all the best this holiday season, and I look forward to working with you next year. Good riddance 2021. Looking forward to 2022 and all the bright that's ahead of us. So thank you for the time today. Look forward to working with you in the future. David Moore, IRA Advantage, IRAadvantage.com. Thank you. Take care. Bye-bye.